This video is a review of moving average valuation of inventory. And moving average valuation is normally associated with perpetual inventory records. So that's something to keep in mind, uh, as I just mentioned up here. Now, the key here is that the inventory cost per unit basically is pretty simple. It's computed after each purchase transaction. So we're going to go through the steps here. We have a perpetual inventory record. You can call this a physical card or a computer record, whatever you want to call it. But we see our date, the type of transaction, the number of units that were involved, the cost per unit, the cost of the transaction, the resulting number of units on hand, the inventory dollar balance, and the computed cost per unit. So if we take a look here, we have a situation where we had beginning inventory equal to 100 units on hand. And the inventory dollar balance in total is $2,000, and that computes out to $20 cost per unit. Now let's take a look at date number 1. And in this case, the transaction is we're buying something, we're purchasing 20 units. The cost per unit to purchase this is $32 a unit. So we take our 20 units times $32. That means our transaction total is $640. Now we move on to units on hand. We add the units purchased to the balance on hand. So we had the 20 units that we purchased plus 100 units previously. So now we have 20 units on hand. Now our inventory balance, what happens is we take the previous balance of $2,000, we add the $640 from the transaction that we just encountered in this step right here, the $640. So our inventory dollar balance now is equal to $2,640. So we take $2,640 and divide it by the 120 units on hand. That means our new cost per unit equals $22 per unit. Let's go on now to the next date, date number 2. In this case, we're going to be selling some units, so we're going to see how that is costed. Okay, now in date number 2, our sale, we sold 70 units. Now, the cost per unit in this case, in our sale, this is not the sales price unit, but the cost per unit, it's $22. And we get the $22 from the cost per unit from our previous transaction where we said $22 per unit. So we take the 70 units times the $22 per unit that we'd previously calculated, and that comes out to our transaction cost comes out to $1,540. So we'll remember that here, and we'll get back to that in a minute or two. We take a look at our units on hand. They started at 120, but now we subtract out the 70 we sold. So now in our perpetual records after the sale, we're going to have 50 units on hand. Now we take a look at the inventory balance in our financial records. We started out with $2,640. Now we subtract out a value of $1,540, which came from the transaction that we costed here previously. So the difference between the two now is we have a remaining balance of $1,100. We take the $1,100 balance and we divide it by our 50 units remaining, and we have a value of $22 per unit. So let's go on now to date number 3. And in this case, we have a buy transaction. And in this case, we're buying 30 units. And for some odd reason, we're only going to have to pay $14 a unit for these particular units. So if we take a look at the total cost of this transaction, it's going to be the 30 units we're purchasing times the price we're purchasing them at of $14. That means our total cost for this transaction is $420. So now remember that we bought 30 units. So we had 50 units on hand previously. We had 30 unit purchase. So now we have 80 units on hand after this transaction. Remember, our previous inventory dollar balance is $1,100, so we start off with that. $1,100 plus the $420 transaction. So now our inventory balance equals $1,520. So now we take that $1,520 and we divide it by the 80 units that we have on hand. And now our new average cost, our moving average cost now is $19 a unit. So all the inventory, units of inventory are now valued at $19 a unit. We go on to date number 4. And in this case, now we're selling some units. And in this case, we're selling 40 units. And again, this is not the selling price. This is the cost that we've computed from our moving cost per our previous transaction. So it's $19 a unit. So if we sold 40 units and we valued them at $19 a unit, that means the cost would be now $760. So that's the cost of this transaction. The units on hand started out at 80. We sold 40 units, so we have 40 units remaining on hand. We take the $1,520 beginning balance from our previous transaction. Now we subtract out the $760 costs from our present transaction, and we have $760 remaining in our inventory dollar balance. So our $760 remaining divided by the 40 units that we still have on hand shows that our average cost is $19 per unit. Now that we've gone over 4 separate transactions, let's take a look at the journal entries these transactions would produce. Transaction number 1 is where we actually purchased our some items, and the transaction cost was $640. So we debit inventory for $640 and credit, let's say, accounts payable as a balancing entry or cash, whatever you want to use in this case, for $640. On date number 2, we sold 70 units for a total transaction price of $1,540. And remember, we got that number from our average cost per unit. So $1,540, we would debit cost of goods sold and credit inventory for the $1,540. In year number, or transaction number 3, we purchased $420 worth of inventory at a cost of $14 a unit. So we would debit inventory for $420 and credit, say, accounts payable for $420. Then on date number 4, we sold 40 items. And again, 40 units times $19 average cost per unit. So that would be $760. So we would debit cost of goods sold and credit inventory for $760. So now you see the journal entries that are resulting from this perpetual inventory moving average valuation. Now let's take a look at question number 1. And what it's asking you for, it's giving you some information regarding inventory movement, and it says, under the moving average method, what is the amount of inventory at the end? What is basically the value of inventory, I should say, at the end of the month? So again, this obviously, again, we're saying moving average, so this would be perpetual inventory system. So go ahead and stop your video, do your computation, stop your video. Okay, under the moving average method, what is the amount of inventory that should be reported at the end of the month? In this case, the answer is B, $3,225. We're going to recreate the perpetual inventory transactions based upon this listing of inventory transactions here. So again, when we say average pricing, again, that means that the average cost is computed after every transaction. So we start off with our beginning balance of 1,000 units, and they're worth $1 a piece. So we have 1,000 units. The accumulated cost is 1,000. So the average cost per unit is $1, as we would expect. We then go out and we purchase 600 units at $3 a piece. The transaction cost in this particular case is $1,800. Now, when I say accumulated number of units, that's the same thing as quantity on hand. So in this case, it would be the 1,000 number of units beginning plus 600 additional units from our purchase. So that would be a total of $1,600. And if we take a look at our accumulated cost, it would have been the 1,000 original cost plus the $1,800 transaction cost, which means our accumulated cost, in this case, our inventory cost would be $2,800. If we take the $2,800 and divide it by the number of units on hand, it comes out to $1.75. That's our average cost per unit. Now we have sales on day 26, which we sold 900 units. So what happens is, again, we don't really have a transaction cost per se, because we didn't really basically this is just a sales price. We have to come up with the cost, so of how much will be taken out of our accumulated cost. So in this case, the accumulated number of units equals 1,600, but now we have to subtract out those 900 units, means that the units on hand now is $700. Our accumulated, or our inventory cost, is equal to our $2,800 minus our total sales. Now what we're going to do is we're going to compute our $900 worth of sales times 1.75, and that should come out to, I believe, $1,575. So we take the $2,000 accumulated cost, subtract out $1,575. So our remaining accumulated cost now is $1,225, our inventory cost. So then we go on to day number 28, where we purchase 400 units, and in this case at $5 a unit. So our transaction cost in this case is $2,000. Our accumulator, or our quantity on hand, goes from 700 units plus 400, so now we have 1,100 units on hand. So we take the $1,225 cost plus our $2,000, means that our total inventory cost is $3,225. We divide that by our 1,100 units on hand, and our average cost per unit now is $2.93. But here what is asking for is what is basically the value of the inventory at the end of the month, or the end of the accounting period, which would be equal to $3,225, which is answer B. And with that demonstration, that is the end for inventory, perpetual inventory moving average valuation.